Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist, taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
Hi, everyone. Welcome to episode 93 of Carson's Facts versus Feelings. Ryan and Sonu here. Sonu, first things first, can you hear me? Sonu, are you there? Sonu, can you hear me?
Oh, yes. Now I can. My ears are stuffed.
Now, explain to us. We know that a lot of things going on this week, but little fun. You're tone deaf right now because you're not tone deaf.
No,
That might be the wrong way to put it.
I'm just deaf.
You're just deaf. You're just, well, maybe who knows? Maybe we're all tone deaf sometimes too. But you're deaf right now because you were partying at Wrigley Field last night, Sonu. What were you doing exactly?
Yeah, watching Journey and Def Leppard, and so it was quite a night. It was fun. I mean, watching them, especially when you grow up with these bands, as you and I have. It's blast. I went with some college buddies too, so it was really a blast from the past in more ways than one.
Wow, I know you invited me, and I'm too busy. I really would have loved to have gone. I've always made the joke, like a band like Def Leppard, like pour some sugar on me. They should play it first. They should play it last. They should play it in the middle. I mean, I don't think anybody would complain if you played that song multiple times. But how was Journey? Def Leppard's awesome. How was Journey?
Fantastic.
What do you think?
It's fantastic. They've had the guy from the Philippines as the lead singer.
That's right.
Okay. From like the mid 2000s. This guy. Yeah. It's so uncanny. He's exactly the same. It doesn't sound
Steve Perry. I believe Steve Perry.
Yeah.
So it sounds just like Steve Perry.
And I believe Steve Perry.
Maybe listeners can let us know. I believe the story is they saw him like on a YouTube video, and they go, "Wow, you really sound like that." They flew him in. They go, "You sound just like Steve Perry." And they said, "You need a job."
New Steve Perry, and the crowd is great. It was fun. There was a storm coming through, so Def Leppard basically went blasted through their set because I think the cops must have told them, "You guys need to end this early enough before there's a tornado watch for Chicago."
Wow. Well, I'm glad you made it. I'm glad it was safe. I know you've got Pearl Jam coming up. Our CEO, Bert White, I believe, will be in town with you for that one. So we'll get a live update on Pearl Jam in a few weeks. But let's just get into it. I'm glad you had fun there.
A lot of things happening at Wrigley. OSU is playing Northwestern too, and I know hopefully you can make it for that.
Yeah, I tell you, we need to see a game besides baseball or something at Wrigley besides baseball. It'd be cool. So again, this is episode 93 of Carson's Facts versus Feelings. We're calling this one "Inflation is Last Year's Problem." We've used that a lot as a tagline that seems to be sticking with people. And after last week, it absolutely is sticking. We're going to spend some time talking about, obviously, the terrible news over the weekend, the assassination attempt of former President Trump. Talk just briefly about that, what that could mean, or what potentially, what could fall out from that be. The rally in small caps, and believe me, I want to talk about this because you and I know, Sonu. Listeners know we've talked a lot about why we liked small caps.
There's some things
some things we needed to see happen, and fortunately, that is happening in a big way. A little bit about obviously what triggered that, the CPI data, maybe a little bit about PPI as well, inflation data, and then probably finish it up. We're trying to keep it 40 minutes here with the consumer retail sales came out just this morning. I know, Sony, you've had a chance to dive in a little bit. Once again, the consumer is not going away. All right, so first things first, obviously Saturday, 6 o'clock Eastern time, give or take, everybody's phones start going crazy with the terrible news that happened. Obviously, we're relieved and glad that President Trump avoided, we avoided a very bad day in our nation's history. It was still a pretty darn bad day. I got the question, I know you did too, how in the world were stocks up on Monday? I mean, how were stocks up on Monday when you see the division that's out there? And hopefully this brings some unity, let's be very clear, but we don't like to get too political on this podcast. We state the facts, but why was the stock market up yesterday then? I mean, how's that possible? It's like we just keep going up, and there's an assassination attempt on a presidential candidate.
Yeah, I think for the, to put it bluntly, which is not to say these things don't matter. These matter a lot, right?
Absolutely.
And, but for markets, it's all about, what can be priced in, what is priced in, what cannot be priced in. right? And why was it up on Monday? Well, stocks are, I don't know where stocks are right now, but probably the same reason it was up
I'm
on
sure they're up.
Friday.
No, they're up every day. I mean, it's a joke, compliance. It's a joke, but it feels like they're up every day.
I know. For the same reason stocks are up on Friday, for the same reason stocks are up on Thursday. We'll get into inflation numbers. I think a lot of focus is on what happens with this rate cutting cycle. It's no longer a matter of if there will be a rate cutting cycle. It's a matter of how much are we going to get and when does it start. I think that's the thing. With respect to the events over the weekend, obviously it's tragic. Like I said, it matters. But with respect to markets, I mean, I like using the Donald Rumsfeld framework for thinking about risk.
Right.
So there are known knowns, known unknowns, and unknown unknowns. Markets can price known knowns, right? Think about inflation. If if you tell someone, okay, we're going to have 4% inflation for the next decade, the bond market can price that, right? If you know, crystal ball, we know it's 4%. But if you tell someone, okay, that's a known known then. But if it's a known unknown, it's like inflation may be volatile, maybe it's not. There's an election, there's volatility. Okay, that's a known known. You sort of price it. Where do you see that pricing? You see it in higher volatility, higher risk premiums, things like that, right? And then there are unknown unknowns. I would put like political events such as these, what happened over the weekend, maybe what happened in Israel tragically last October as well. That could be examples of unknown unknowns. Markets don't price that. But once it happens, it's beyond us, right? So they look past it in a way. Like I said, not to say it doesn't matter, but for markets, they move forward.
Well, exactly. And we'll kind of move forward here. Obviously, we're paying very close attention. You can go to carsongroup.com/election for all of our election content that we've been sharing. And one of, I hate to say favorite charts, but it's one that's popular, is how stocks do around major political events. I don't like updating this chart, but when you look at it, Sonu, we now have I've got 40 major geopolitical events, starting with World War. Let me see the first one. Germany invades France, May 10th, 1940. Pearl Harbor, up to the President Trump shooting on the 13th, just this past weekend.
No, I was typing because I was looking at 1975, Gerald Ford, which I didn't know up until this weekend when I was looking at the history of this stuff. Gerald Ford was, there was 2 attempted assassinations of Gerald Ford, President Ford, in 1 month. And the S&P 500 is up 32% in 75. That's what I was checking. How much?
Oh, wow. Maybe I need to add that to my list. I make these numbers better. But what I'm showing again is major geopolitical events, 40 of them. S&P's up on average 3 months later. It's not like massively, but again, we're not minimizing these geopolitical events. When Hamas attacked Israel again, as we know, October 7th, S&P up 20% 6 months later. Remember the initial reaction, the market selling off, oil spiking. I mean, very, very serious things, obviously, that are still taking place. But markets have a funny way, if the economy is strong, of kind of, I hate to say ignoring, but in a way, brushing off these geopolitical events. So we just wanted to touch on, obviously, the news over the weekend. But now we're going to get into what I think some of the fun stuff, Sonu.
All right.
The rally. Now, let's be clear. The rally.
Don't stop believing.
Yeah, don't stop believing. Exactly. The rally started because inflation's getting better. We're going to talk about inflation next. We're not starting with inflation. We're going to get to inflation. But the rally was unbelievable. I know I've got a bunch of stats and figures, but what struck you from Thursday's rally, again, on better inflation data? And I'll read some numbers here once I find them. What'd you think?
I was surprised as to how surprised everyone else was.
Oh, I like it.
That's because you and I have been talking about inflation numbers are cooling. We didn't think there was a sudden surge of inflation. Never mind all those folks who said after March and April, stagflation, things like that. Economy is slowing. Inflation's going up. No. We were always on a disinflationary trend. What happened in the first quarter with inflation, we'll talk more about it, was idiosyncratic things, shelter, auto insurance, things like that, right? We never thought it would be veered away from that path of disinflation. And we were bound to get a report like this. I think Neil said it best. I love what he said. The stars aligned for this report, right? Yeah. Everything fell into place, but it shouldn't have been a surprise. This was coming.
And that's our friend Neil Dutta over at RenMac. We should have like a disclaimer. Like if we say Fed, we mean Federal Reserve. If we say CPI, we mean Consumer Price Index. If we say Neil, we mean Neil Dutta over at RenMac. So just some numbers, some figures, just how crazy strong the breath was on Thursday. Russell 2, that's small caps, was up 3.5%. S&P was down almost 1% on the day. You got to go back to October 10th, 2008, Sonu, last time we saw
That's
that.
right. I forgot.
Yeah,
S&P
people
was
here.
down.
Yeah, exactly. It's crazy to think. And why? Why was the S&P down? Because in the Russell 1000, 11 of the top 12 stocks were down. So like the Mag 7, all these big leaders, the money flew out of the big names and into small, mid caps. Honestly, everywhere else, 394 stocks are up out of the S&P 500 again, but it was down almost 1% on the day. Our friends over at Bespoke noted that the equal weight S&P 500 outperformed the S&P 500 by more than 2%, just over 2%. That's the third largest day ever. Some of the previous best days ever, Pfizer Monday, remember that one? November after the election 2020.
Vaccine Day?
Vaccine Day, I guess we'll call it Pfizer Monday, Vaccine Day. Big rally, kicked a huge rally. May of 2020, we also had a day like that. In April of 2009, think back to those times. Those times were really good times to be considering the fact that bull markets were continuing. Let's be honest, this time we're like at all-time highs, and it happened. Those previous times were not all-time highs, but still, I'd rather know it than not know it. So this is why I want to bring you in, because I guess it's fun, because obviously you're an engineer, right? You literally like we're a rocket scientist in college, and you know this stuff. The Russell 2 outperformed the NASDAQ by 5.8%. Okay, what in the world does that mean? That's like one of the largest ever. I think the second or third largest ever. But it was a 6 standard deviation day. Doing the math, 6 standard deviation should happen once every 506 million days.
Nice.
It happened on Thursday. Talk to me about how markets really are not so efficient. I guess markets really aren't as efficient as we think, are they?
And to think, you think, okay, if this is the only time it happened in market history since,
right,
or let's say, since the late 1800s, right? When you go back to the Dow, I know the Nasdaq doesn't go back as far, but look, the reality is it happened. We saw something like this in 2008. We saw a lot more of these moves in 2000, 2001, 2002. I immediately want to qualify this by saying I don't think we are in a bubble or anything like that. Back in 2001, 2002, the dot-com bubble burst. We saw some big moves, small caps above the NASDAQ, similar to what we saw on Thursday, a 6 standard deviation move. Right. Reality is, this gets to the part of, so when you ask me, like, what surprised you, right? And we talk about momentum all the time. Momentum begets momentum. And why is there momentum? A behavioral understanding for momentum from the behavioral finance side is that people don't react to news immediately. It's like there's a catch-up effect, right? As people go back into like, maybe the news is better than I thought it was last week. Maybe that CPI number in April and May and June was a little better than I expected. Now we make the move, and suddenly there's a herding effect. A lot of people making the move at the same time, and then we get a 6 standard deviation move like we did on Thursday.
Yeah, it's just I don't know. Markets aren't as rational.
Yeah,
as I think we think they potentially can be.
And
the
I
longer
think
you do
momentum,
this, you see that.
momentum is the perfect, example of market quote unquote irrationality.
Yeah, a few more interesting things. It's not like it was just Thursday, by the way. For the entire week, the Russell 2 was up 6%. NASDAQ was flat. Okay, so that's pretty rare by itself. What else do I have here? Then in some numbers I played with, the Russell 2000 outperformed the Russell 1000. So you could think of that like small caps versus large caps by more than 3%. It was actually 4.3%, one of the largest ever.
Wow.
I found, Sonu, only 5 other times, right, where you saw an outperformance of at least 3% on one day from small relative to large. Those dates were 1987 low, October of 2008, October 2011 low, March of 2020 low, January of 21, kicking off a pretty darn good bull market in 21, then November of last year. Obviously feels like we've been up a lot since November of last year, and then it just happened last week. 1 year later, higher 5 out of 5 times, up 32% on average. We're not calling for 32% rally, but I am saying small sample size, maybe, but it's something I would not want to ignore. One more, then I want your opinion here. Russell 2000, by the way, a week ago today, we do record this on Tuesday, the Carson Investor Research Team released our mid-year outlook. If you did not get a chance, listen to last week's podcast where we discussed the mid-year outlook. we discussed why we liked small caps. A week ago right now, everyone hated small caps. I mean, literally, like people were talking about, why would you ever invest in small caps? Podcasts are saying, why would anyone ever invest in small caps? Here we are a week later, Sonu, and the Russell 2 has been up 1%, at least 1%, 4 days in a row. It's up 5 the time we're recording this. We'll see if we get there. So I looked at when up 4 days in a row, the Russell 2 small caps is up at least 1%. Only 13 other instances since 1979 when the Russell 2000 began trading. 1 year later, higher 11 out of 13 times, up an average of 25.3%. Median returns a little bit lower, but it's still pretty darn positive. A lot of numbers, a lot of figures. This is facts versus feelings. We're dropping some facts. What we just saw on last Thursday, what we've seen the last couple of days is market breadth expanding. It is likely a sign this bull market is not ending. It's likely a sign the bull market is alive and well. It's just maybe different parts are going to lead it. One final comment, Sonu, then you. I've said a lot before, and a lot of other smart technicians say this. The lifeblood of a bull market is rotation. You don't want the same groups leading all the time. You have to pass the baton around. I think the baton has been passed from some of those previous leaders to some of the areas like small cap, mid cap, industrial, and financials groups we've said a lot we like, and it's taken place. Sonu, I'll be quiet for a minute or two. What do you think?
I was just wondering, I guess both of us sort of internalized this in some form, which is why we both ended up wearing the facts versus feelings T-shirt.
I was going to say, nice shirt. Go to YouTube. Nice shirt. Yeah. Well, we're in the same shirt.
We're probably on the same page, So,
yeah.
No, I was going to ask you, what if the Russell 2000, the small cap stock, the small cap index, Russell 2000 is up 5 days in a row? Because right now, as we speak, the Russell 2000's up 1.5 to between 1.5 and 2%. Right, so we get 5 days in a row there. But
I haven't done the exact. I've got my spreadsheet open. I don't have the returns. I can just tell us this: the last time. Oh wow, this is interesting, Sonu. The last time we had 5 in a row, April 28th, 2000. We actually had 6 days in a row. April 29th was the 6th day in a row of a 1%. That's the record. 6 days in a row of up 1% or more on the Russell 2000. I see a 5-day one in late 1998. Now I will list add something for everybody. We had a 6-day 1%er in January of 2000. Now let's be clear. January 2000 was not a good time for the stock market. We know that. But it also kicked off an extremely long period of outperformance of small caps because small caps are still down, but they outperformed by a wide margin because they underperformed for like 20 years. So again, when I'm just eyeballing this, so then I've got a September 2009. We had 5 days in a row of at least 1%. So I don't have the exact returns afterward, but you see those dates, you hear those dates. Those weren't the worst times for the stock market. 2000 maybe was, but they definitely weren't the worst time for small relative to large going out, a decent amount of time. I mean, I don't know. Pretty interesting.
No, well, we said it last week. I'm pretty sure we said it last week. I mean,
if we didn't, let's just say we did. Let's say we did.
We did, right? Or you guys, you all can go listen to it. But this is why even within equities, people always say don't put all your eggs into one basket, right? And then you think, I should diversify stocks with bonds, gold, whatever, right? And then, but even within stocks, you still want diversification. You don't want to bet everything onto one side of the market. I mean, Ryan, as you just said, if you're in a bull market, rotation is what you expect to see. Rotation is what you want to see. Rotation has historically been what we've seen as well, right? Rotation is the lifeblood of a bull market. So you don't want to bet on just one side of it, right? And here's a stat. I was just looking at this since you brought it up. I mean, so between 2000 and 2003, again, I want to qualify this by saying we don't think there'll be a bear market anytime soon.
Right,
Ryan, I'm pretty sure you'll agree with me on that. I mean, I'll follow your lead.
It's a bear market for bears. We'll leave it at that.
It's a bear. Fun. Yeah. Yes, there you go. So between 2000 and 2003, right? And I bring it 2000 to 2003, stocks were down. The SP was down about 41%. Between March of 2000 and March of 2003. The NASDAQ, the Qs, for example, was down more than 70%, 75%, something like that. Small caps. You think small caps are high beta, which means they're more volatile than the market. You think if the S&P is down 41%, 3 years, what do you think the small cap?
Well, I would say, let me guess. Given you're doing this, it's obviously better. We're doing this for a reason. I'll say down 11.
Down 19. Not too bad.
Hey, not too bad.
But
okay.
Better by more than half, right?
That's pretty good.
Yeah. And this is for a very volatile part of the market. So again, like I said, we don't think this is a bubble. We don't think this is a bear market. unless you're a bear. That's a bear market for you.
Yes.
Go like that. But yeah, you want to diversify even your equity portfolio.
What well said there. Another reason we didn't talk about this last week, but I'll do a blog, carsongroup.com/research. You can find this blog probably by the time you listen to this podcast. I'm gonna have a bunch of charts in here. It might be a crazy chart one, but why we like small caps. A lot of it's straight from our mid-year outlook, which you can listen to or read. I'm sorry, and listen to what we said last week. But a lot of debt is the issues with debt when it comes to small and large caps. So when you look at the S&P 500, Sonu, 10% of the S&P 500's debt is floating. 90% is fixed debt. Not too surprising. We've talked about that before, where large companies have financed a lot of debt at a lot lower rates. So what happens when interest rates are higher right now? The economy might be stronger, and you think, well, shouldn't a strong economy be good for small caps? Yes, but you have to add some more flavor to the cake, so to speak.
So there's an example, like for example, what you're saying is Apple borrowed money at, let's say, 3%. For 30 years.
They did. Apple, Microsoft, they all did. Dumb luck or not, they did.
And they're getting a lot of cash. They're huge, massively cash rich, and they're getting 5.5% on that.
Sitting in T-bills, sitting in money markets, wherever it is, just getting, and that's, I think, one of the reasons, not believe me, there's others, but that was one of the reasons large did so well. But here's the thing, just to keep note, when you look at small caps, Sony, the recent data shows fixed debt is 51%. Floating debt is 49%. So like half of all the debt's floating. So what do you think? If interest rates are way up here, is that good for small caps, small companies? Financing's more expensive, harder to get stuff done, harder to reinvest, harder to get good employees to work for you. All these things probably tougher. Now with what we're going to talk about next, with inflation getting better and probably a dovish Fed coming, that is why we're looking at the Russell 2000 up at least 1% 5 days in a row the time we are recording this.
And I think that's why the rate. No, I think that rate cutting cycle is so. Why small caps are so geared to this rate cutting cycle or expectations for one.
Right.
Because when you're floating rate, and that's why like interest rates, both sides of it matter, because usually when you talk about Fed rate cuts or rate hikes, things like that, at least for me, my first thought is usually the housing market, because it impacts mortgage rates, and housing is that volatile part of the economy. As goes housing, so goes the business cycle, as they say. Right. Yeah. I mean, we caught a break in 2022, I think. Despite housing crashing, because the consumer is so strong, we didn't go into a recession. Whereas historically, that's happened. Housing has led the economy into a recession. Housing's struggling right now because long-term interest rates are higher, right? But what you just brought up with small companies borrowing money, it's floating rate. So it's more on the shorter side of the curve, of the yield curve. You're talking about shorter-term interest rates. That's where floating rates are benchmarked to, things like that. And that's why if the Fed cuts rates, from 5.5 to 5 to 4.5. Now, we don't think they'll go much below 3.5, but that's where I think the next big question is, where do they end up?
Well, let's not answer that yet. Right. Let's take a little break. But I mean, so anything else you want to talk about the stock market, the action over the last 5 days? I mean, I'm kind of good. I said everything I wanted to say. Anything you want to add, Sonu? It's earnings season. Maybe we'll talk more about earnings next week. It's earnings season. There's drivers. We've been bullish. You listen to us. We've also said we like small and mid the second half of the year. Boy, oh boy, that seems to be taking place.
Hopefully it continues. That's it. That's all I can say.
Exactly.
And we think it will continue.
We do. All right, so a little story time. So I picked my son up, Sebastian, who's sitting right in front of me, and he's supposed to go get the dog out of the thing.
Playing a video game?
Yeah, he's playing a video. Yeah, it's the new what is it called, Sebastian? What is it? He's playing the NCAA. It just came out. That new game hadn't been out for 10 years, so he doesn't do anything but play this video game. He's so excited about this new football game. Listeners probably know exactly what I'm talking about. Anyway. Where was I this? Oh, last night. Picked him up. We were driving in the car. His friend Bear, I was taking him home. And all of a sudden, my car starts dinging at me, Sonu. And I said, what's this? And I looked, and my back right tire was 39. All the rest of the tires were 39 PSI. It was 29 PSI. I go, that's kind of weird. Go like another half mile. It drops to 16 PSI. I go, this doesn't sound good. Go like another quarter mile. It goes to 11 PSI. Now the car is starting to make a little noise. I go, this isn't good at all. I'm like a mile from exits. I don't want to pull off this highway. You see stuff. I just want to get off. So if I screw my car up, I'm getting off this highway. So I'm going like 30 miles an hour.
So what's the expected value there? Do I get off? Do you stop on the side of the road and wait an hour for somebody to do this?
With kids in the car, and you never know. It's getting dark, and you just hear bad things can happen.
Or do I roll the dice? And so what do you do?
I rolled the dice, and I just put the flashers on, went nice and slow, and then we got off the highway, went a little bit, and I just was clear. Then by then it was zero
Wow.
PSI back right tire. I was like, wow, this is great. Pull over. Long story short, call my wife. They come, and then Phil, like an angel. Phil listens to this podcast. Thank you, Phil. Phil came. My buddy Phil came, and it took a little bit longer. It's kind of one of those jokes. How long does it take to change a tire? And I don't know how to change a tire at all. I'll be honest. I don't do that stuff. But we figured it out. We got there. Put the spare on. Took it to I won't mention who. It's a local car dealership, and this morning they told me it's about $1,200 for 4 tires. I probably need to do tires anyway. So, and they said structurally the car's okay, because that's what I was worried about. I drove on a flat tire probably for a mile. Probably. I know you're not supposed to, but hey, I did it. I wanted to get off the highway. It sounds like, knock on wood, $1,200 in and out the door. Get some new tires is a couple hours of my life I don't ever want to do again anytime soon, but it's happening, and I continue to help the economy. That's what we talk about, those car things, right? I was worried, oh boy, Sonu tells me car things are more expensive. $1,200 didn't feel too bad for new tires. How's you had car issues
don't
last
ask.
week?
This is what I want to hide under my desk. Don't remind me of like my smoke coming out of my ears.
Oh boy.
Our car just got towed out of our garage yesterday. And so we had to, because we couldn't even get into the thing. See, this is the thing with, like, if it's an old school car, less electronics, things like that, you can get into the car, you can put a couple of wires together, you can start the damn thing, right? Like, but now it's like, it's all electronics. You completely shut out of the car. So we had to, there was some way, the guy who came to tow the car, he was like, I need to put it in neutral.
Right.
I was like, well, we can't start the car. How do you put it in neutral? We can't even get into the car. So finally figured out how to get into the car. We didn't have to break in. He got it into neutral.
Is it really breaking in if it's your own car? I mean,
yeah. That could be a title of the podcast. Sonu broke into his own car. Sonu broke into a car, but
yeah. Oh my goodness.
Anyway, I may be on the market for a new car. I mean, I'm hoping I can take this thing at least through the end of the year. What's a good time? Maybe readers can send us an email. Like, what's a good time to buy a new car? I don't know.
Well, that's true. Let's see here. So that's a good point. If you want to hear the latest from us, don't forget to subscribe to our podcast. You can leave a review. We love your feedback. And again, we are also, we have an email, right? Facts versus feelings, VS, facts versus feelings at carsongroup.com. Some of you have been sending some emails. We appreciate it. Send us emails. What type of car Sonu should buy. Maybe what type of tires I should have. I think I'm getting Cooper.
Costco.
I don't know.
Costco
Cooper?
is, that's what.
Good for tires.
I remember several years back, we had to, replace the tires in a car for probably some similar reason like you. And that's when we decided to take a Costco membership. Like, okay, get some tires.
Paid for itself.
We've had the Costco membership since then. And I think the hot dogs have paid for itself. So.
Ooh, I see I don't go there, but I see they say inflation has not hit the Costco hot dog yet, is what I know. So, all right. Speaking of that, good segue. We've got maybe 10 minutes here, we've got 10 minutes or so. We'll talk about inflation, right? Last week, as we talked on the podcast before, CPI was coming out on Thursday, the consumer level, then the producer level on Friday. Sonu, we already talked about the market reaction, historic in terms of broad participation, in terms of small and mid caps. You've had a few days to think about it. What did you think when you looked at the CPI and then also, I guess, the PPI? But I know CPI was kind of the star. What did you find?
My first thought was like, boom. Here we go. I mean, within the context of everything that's happening is probably the wrong word to use, but that was like my first. And so this is on Thursday morning. I was like, yeah, here we go. Right. And like I said, as our friend Neil Dowd said, the stars aligned. This is the picture perfect CPI report, Consumer Price Index report. This is for June. Here's looking back, right? Like one month can be volatile. The headline CPI was down negative 0.1% month over month in June. Expectations for a flat reading. Looking back over the last 3 months, you want to expand that time horizon. So last 3 months, headline CPI. So this includes all of it, right? Food, energy. We're not taking anything out. 1.1% annualized pace. Last 6 months, 2.8% annualized pace. Last 12 months, 3% annualized pace, right? 3% year over year. So then you think, oh, wait a minute, inflation's still at 3%, because that's usually a very popular number to report. Inflation's up 3% year over year in June. Look, that's solely an artifact of lagging shelter data. You and I have talked about it. Yep. I'm not going to go into.
So I think we've done 93 of these, or I think we've talked about lagging shelter for probably 78 of them. I'm serious. Like we've been talking about this for a while, but it's happening. Mm-hmm.
No, shelter lags, right? Official shelter inflation lags. Now everybody and their mother probably hopefully, maybe my wife doesn't know about it. I should ask her. Do you know why CPI inflation is 3%?
No, I'm not asking my wife. I'm going to say she has no idea what we're talking about.
Yeah. But anyway, you take out shelter. What did I say? Headline CPI last 3 months was 1.1%. You take out shelter, keep everything else in, food, energy, all of it, right? Negative 0.5%. Deflation outside of shelter over the last 3 months. Last 6 months, headline is up, what did I say? 2.8%. You take shelter out, 1.6%. Year over year, instead of 3%, we are at 1.8%. That's why I say inflation, that the inflation problem, I'm not, and this is not to minimize the fact that all of us are paying more prices, things like that for strawberries, eggs, mayonnaise, whatever it is, right? We are, right? And you and I have talked about how those prices are not likely to go down. I mean, in fact, we kind of don't want it to go down because when does it go down? Maybe if you're in a recession, right?
Right.
But inflation, as far as it concerns policy, the Federal Reserve, all of that, the inflation problem's over. Inflation was last year's problem.
That's the title of the podcast. Inflation was last year's problem. I mean, let's talk about that shelter because shelter had been stubborn, but I know we saw some pretty good sized cracks to the good side, to the good guys with shelter, OER, rents, those things really coming back. Is it finally just happening, or do you think it's a one-off event where next month we're going to see shelter just get back to stubborn? What do you think when you talk about shelter? Because again, it's 41% of core CPI, so shelter matters.
Yeah, it's and core CPI is taking out food and energy, right? I would say I think it's a 43%. I mean,
even more. There you go. Okay, yeah.
But
close enough. Yeah.
Shelter has two pieces. One is rents of primary residences, which totally makes sense, right? Yeah, rents should be counted in inflation. But then you have the other piece, owner's equivalent rent, which is the price, homeowners presumably pay for their homes. It's not based on home prices, by the way. Home prices, as I've said several times in the past, don't go into CPI or even the Fed's preferred metric, personal consumption expenditures price index. It's based on rents, right? It's look at market prevailing rents around that home, and they assume the official, the BLS, Bureau of Labor Statistics, assume that's what you're paying yourself if you own a home. So rents of primary residences rose at an annualized pace of 3.4% in June, right? What does that mean? Before the pandemic, we were at 3.2%. They're pretty much right there. Owner's equivalent rent, which is actually 35%. The bulk of this 43% is mostly owner's equivalent rent. That rose at an annualized pace of 3.2%. Before the pandemic, we were at 3.6%. Now, was June a one-off? Maybe the size of the decline was one-off. We could see, maybe instead of 3.2% in July, maybe you see 3.5%, 3.6%, which is still okay. That's where we were before the pandemic. But there's reason to think that it's actually the previous months that was skewed higher, especially April and May. So actually, the downtrend is smoother than what the data shows. So, and we know, you and I have talked about this, apartment list, Zillow, all of that. Even the BLS's own new rental lease data shows that inflation for shelter is going down. And
it's their own data. Their own data says it, but the other data doesn't. So wrap your head around that.
Yes, exactly. So look, official data, like you take apartment lists, rents are running negative 0.7% year over year.
Okay.
All right. Official data, let's be clear, is not going to be negative ever, right? There's just no way. I don't think it. But we are going to see, I think we are going to see official data go below the pre-pandemic pace, what does that mean? That's going to be a downward force on inflation for the next year and a half, right? So we're in a good place with respect to inflation, but hopefully the Fed recognizes that.
Well, that's what we're going to talk about next. I do want to point out also new cars down 0.2%, used cars down 0.1%, airfare down 5%, hotels down 2.5%, big drop in energy. Those are things people use. Those are things people buy. I mean, those are things that are improving. So we've got maybe 5 minutes. So let's talk about the Fed. A cut in September, I believe, I saw close to 100%, according to the Fed Fund Futures as of this morning. Josh Schaefer over at a Yahoo, Josh shared that. So there you go. I think 100% chance of a cut in December. Now, markets, I mean, we've seen 100% before, and they change. But, that's at least 2 cuts, Sonu. I think you and I are kicking around the idea maybe there's going to be 3 when you look at this. What do you think?
Yeah, that could be September. We're thinking right now, before this, I would say September, December, but I think could be September, November, December. I think, again, to bring Neil back into this, Neil Dada back from Renmac, I think he mentioned this last week that, November 5th is the election.
Right.
I think the day after that is the Fed meeting.
Right.
So they could probably, I mean, obviously everyone's
They have cover. No one's gonna no one's gonna pay attention.
You just sneak in another rate cut, right?
Do a 75 basis point cut. No one will even care. No one will notice. Yeah.
So what's interesting, we could get to suddenly the market's pricing in 100% odds, like probability for 2 cuts, and maybe 50% probability for a third cut. What did we say in our 2024 outlook 6 months ago, Ryan?
I forget. What did we say? Nice teaser. What did we say, Sonu?
They said 3 to 4 rate cuts, right? And the market is at like 7 rate cuts. No chance, unless we went into an unexpected shock recession.
Yep.
Right, exactly. We didn't get that. We're not there yet. We don't think that's happening anytime soon. We're back at maybe 3 cuts.
Yeah, I think so. I mean, round circle, but that's where we were. And I was talking to my friend Paul LaMonica over at Barron's now yesterday, a reporter over there. And anyway, we don't have a ton of time to talk about this, but he mentioned where, do you think Powell will just do a couple cuts here, and whoever the next president is, they tag him out? Because he's been around. He might not want to deal with the new boss. He might not deal with the old boss. I mean, I think that's something we can start talking about as we go forward. But the idea of a new person in charge of the Fed this time next February, I think is pretty darn real. I think Powell said, listen, I did it. There was no recession. You all told me I could not avoid a recession. Right. Without every economist was telling me if you take unemployment down, you're going to have a recession. Or I'm sorry, you're going to need to have unemployment go up to, to get us out of this inflation problem. And that's going to cause a recession. You know what I'm trying to say here. But he landed the plane. We were saying the whole time we weren't giving him a ton of credit. We thought he could land a plane because the consumer is so strong. Yeah. Nonetheless, that's something to think about. I think that we might have new leadership in the Fed. What's it mean? Listen, we'll worry about that a different day. There's other things out there. All right. So the final thing, Sonu, let's wrap it up in a couple of minutes. The consumer, right? The consumer continues to be a big part of the economy. There's a reason to think the consumer is so strong. We really dove into the consumer last week in the podcast about the mid-year outlook. We just had retail sales come in a couple hours ago this morning. What's your high-level thoughts on the consumer when you look at that data?
No problems.
Okay,
that's it. Yeah. I think there's been a narrative that the economy is slowing. You and I have tried to correct that. I think in the sense that, which is not to say it's not slowing. I think we're slowing from something like a 3% pace to a 2% pace. We're normalizing, right? But that doesn't mean the consumer is weak, right? The consumer is still strong. We saw that in retail sales. Headline retail sales was actually flat month over month in June, but that was because gas station sales fell. Why? Right. Because gas prices fell. Right?
As we talked about in CPI, energy was down. Right. Pretty good deal.
And then auto sales fell, and that's for 2 reasons, right? One is you just talked about used car prices and new car prices falling. So that's, by itself, all else equal, auto sales will be down because prices are lower, right? But then the other thing, this is weird. There was some big hack at dealerships or something last month, so sales were pulled down. That's going to come back in July and August, so I'm not too worried about that. Then you take everything else, core control group, as we call it. This is the stuff that goes into GDP. Core retail sales, Ryan, expectations were for a 0.2% increase in June. 0.9%.
Oh my, I didn't know it was that high.
0.9%.
Okay.
Right. Now this can be revised, all of that again. So look at the last 3 months, right? Last 3 months, which is basically the second quarter, core retail sales, which is basically good spending. We talk about online sales, household merchandise.
Today's Prime Day, by the way, for Amazon.
There you go.
I didn't know that, but anyway. And we buy stuff. Every day's Prime Day in our families. I wouldn't notice.
Likewise. Yeah, exactly. So last 3 months, retail sales are up just under 4% annualized pace.
Wow.
That's pretty good.
That's pretty good.
Right. You talk about 4% retail, 4% good, and these are mostly goods, right, that we're talking about with retail sales. Online stuff, healthcare, personal stores, stuff you buy at Target, Costco, tires, for example. All of this is in there, right? That's growing at 4%. Remember, this is nominal. You take out inflation, maybe inflation about 2%. I think it's actually for goods, it's probably going to be lower. You get real sales, real consumption, real goods consumption running about 2%. That's trend. Right, the economy is growing on trend.
Wow, I'm surprised. I just look good stuff there. Just look down. Dow's up over 600 points. Time of recording this, 1.4%. Nasdaq flat.
Wow,
that's like 0.00. Small caps up close to 2. So that the themes we talked about were.
You're gonna have to adjust your chart for 4 consecutive days of.
Yeah, looking like 5. But the theme again, what's in the Dow? Not a ton of tech. some financials, some industrials. The themes we've been talking about are really playing out here.
And you want to remind people again what happened 5 days ago? Not the CPI report. It was our outlook.
So our outlook came out on, let me make sure I get this day right, the 9th, okay? The 10th, 11th, and 12th, that's Wednesday, Thursday, Friday. Small caps gained at least 1% all those days. And so far, the 15th and 16th, the small caps gained at least 1%. 5 days in a row. After people read our outlook and slept on it, small caps are 5 days in a row. I'll just drop the mic there. Thank you to everyone who read the outlook and believed us. That's really nice of you. Just kind of amazing, to be honest. I mean, it just, we come out with a target and market keeps going up and all these things. But our big theme, again, second half of this year, what we laid out is we think inflation is going to be a lot better. A couple of Fed cuts, some rotation into the underloved, underappreciated, and underowned areas are going to take place. It is happening. I mean, I forget the old saying, but sometimes, it takes years for anything to happen, and sometimes years happen in like a day or two. It feels like we're having a year worth of activity. Honest to goodness, we are in small caps and mid caps in the past week. But we think there's more.
Fingers
crossed,
tank. Toes more crossed, everything. But yes, we believe there's more in the tank. It's
absolutely. Sonu, again, we're at the end. Anything else you're watching this week that can move markets?
I mean, I don't know, move markets. I'm looking for there's housing data coming out. There's industrial production. Industrial production, I think a couple of things I always like, I have enjoyed looking at. I think enjoy is the right word here. I mean, I don't know how many people enjoy looking at industrial production.
Just you.
No, this gets to policy, right? Defense production has been surging. I think that continues irrespective of who's in power. Or after the election, and irrespective of Congress split, all of that, right? I think that continues. And high-tech equipment production, that's the other side of it. I think those are two big stories happening in the economy right now.
And you've been talking about those for a long time, that have been positives under the surface. A lot of people either ignored, didn't pay attention to, whatever it was, you were on them saying, listen, these are some positives. We heard for the longest time how PMIs and ISMs were sub 50, LEIs were sub year-over-year negative. Everybody told us how bad it was going to be. You said, no, there's some hard data that's taking place that are saying there is no recession coming. The consumer is good. Manufacturing, throw your shoulders up. It's not as bad as they're telling us, though.
Yeah.
Housing's one part of the world that worries us a little bit if rates stay higher. But again, what just happened over the past week, maybe that's not such a worry. We talked about that again in last week's podcast.
I'm smiling because I see a headline on Yahoo saying retail sales defy Wall Street's predictions for a slowdown.
Yes. Well, take that, Wall Street. That's we wear T-shirts in our podcast, so take that, Wall Street. You won't see that on a Wall Street podcast. All right, everyone, thank you for listening to episode 93 of Carson's Facts versus Feelings podcast. Why inflation is last year's problem. We'll see you next week, episode 94. We're inching closer to episode 100. I don't know what we're going to do. We'll have to do something special. I think you need to break out the guitar, episode 100. Start working on something. I mean, we'll do something special. But thanks again, everyone who keeps listening to it. We appreciate it. We'll keep doing these. Have a safe week. If you've got a vacation or something planned, it's a little bit summertime left. Hopefully get out and do something. And we'll be back next week to keep talking about it. See everybody then. Thank you. Take care.
Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM LLC.